Did you know that if you are a public safety officer, you could be eligible to write off up to $3,000 every single year of your income taxes by using this one little known benefit? So this video, I'm going to go in depth on this federal rule and how you can utilize it to your benefit, as well as the paperwork you need to fill out, right? So this benefit's all made possible by something called the Federal Pension Protection Act, which was passed back in 2006. Essentially, what it's going to do is allow you to write off up to $3,000 per year for money that you've paid towards health insurance premiums, accidental insurance, or long-term care insurance, right? So I'm going to flip over to the DR's website and go a little more in depth in the requirements. All right, so here I'm on the DRS's website for retired public safety officers. So first thing you need to know, they have a description of what's covered up here, which I already kind of told you what it is. But there's basically three things you need to do. First, you have to be a public safety officer. This includes firefighters, law enforcement officers, police, corrections, probation, or parole officers, as well as judges, or be police or fire department chaplain, as well as an ambulance crew or rescue squad member. So that's step number one. So you need to be one of those to qualify. Step two is you have to retire at a normal retirement age. So if you retire early, before 53, and you actually, separate service and collect your benefit before 53, you're considered retired early. You're no longer eligible for this program. If your retirement was due to a disability, you are still eligible. Next step, and most importantly, is you got to make sure that your health insurance premiums, or whatever premium you're wanting to write off, has to come directly from your pension, right? So you have to be a retired safety officer first, collecting a pension, and that your health insurance premium has to be directly deducted from that pension, or your long-term care insurance premium must be deducted from that pension. If you're paying out of pocket, it doesn't count, right? So for you guys, the PEB system, right, the Public Employees Benefits Board, that's one that provides your health insurance as a retiree, whether or not you're under age 65 or over that. If you're on the PEB system, they actually have a form that allows you to deduct your PEB premium from your pension. And so if you're not really doing that, it's something you should look into. And then what you can do is fill out this form to let the DRS know that you're eligible for it. If they review it and say, yes, you are eligible, you're going to receive a letter every January that tells you how much of your premiums are qualified for. And then you're going to take this letter to your tax preparer, or if you do your own taxes, you're going to have to reduce the amount you put on line B on your 1040 form by this number, right? So the tax form change every year, but let's say, for example, in the given year, line 5 is where you have to report your pensions or annuity payments. Line A is the total amount of money that you received. So you'd put the amount that you got on your 1099 there. And then on B, that's the amount that's subject to taxes. You would reduce it by the amount on that letter, right? If you have questions on it, go find a CPA and they can help you kind of go through all that. Now, as far as the tax form goes, it's right here. I'll link this in the description below to the video. It's very straightforward. Just your basic information here, what system you're on, and then you sign and date, and then you're going to mail it or fax it in to DRS, and then they'll give you a letter in the mail saying that if you're eligible or not. All right, so this is a huge benefit that you should be utilizing if you are eligible for it. There's really no reason not to. You can reduce your taxes by up to you can reduce your taxable income by up to $3,000 per year. Remember, that's your income being reduced, not the amount of taxes you're paying. So if you wanted to know how much that's actually going to impact you, you just take it by your tax term. So let's say 20% tax bracket, and you reduce it by the full $3,000. That's about $600 that you're saving in taxes. All right. Definitely look into this if you haven't done so yet, and also make sure to like and subscribe so you don't miss future updates just like this one. I'll see you guys all next week. Remember that your future depends on what you do today.